So anyway, they're saying the Fed's behind, and basically the Fed's worthless, and everything they do is worthless, and the Fed funds rate is worthless, and you just got to watch the market, and they're following the market, not leading the market.
Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate. So let's get started. Here's your host, Kevin Peranio.
Hey, it's KP coming to you live from America's team, right there. That's the gates of heaven. And of course, if the sun is shining in their eyes, it is the gates of hell. We're in Arlington, Texas. And we are at the Mortgage Collaborative event. Total Expert just put on a pretty awesome cornhole tournament. And I'll just say that Dan Catnell and I got pretty far into the quarterfinals. And the other team got a ringer that wasn't even redshirt, and he absolutely murdered us. This is the finals. It's still going on. Hey, David Ledkin, let's go. Fucking legend right there. All right. So the Mortgage Collaborative is a group of independent mortgage bankers, credit unions, banks, and whatnot. And we're all here to collaborate. And it's a great event. Lots of good vendor partners here. We're learning quite a bit. The speakers are amazing. And I think their next one's in like Boston or something like that. Anyway, okay, Fed week. Big deal. Really big deal. So let's talk about the Fed. By the way, check this out. We're at the Lowe's, live at the Lowe's. So Lowe's Hotel, and I think the TMBA, Texas Mortgage Banker Association, the last Sunday, Monday, Tuesday, Wednesday of April are also here. And so Globe Life Field is where the Rangers play. That's right here. There you go. And then you saw America's team, Palace and Dallas. Okay. The Fed, the talking. I heard a really hot take, and I think this is very interesting and worth listening to. I subscribe to a lot of subscription services for stock analysis, raw data. And there's one that's kind of like always pushing gold, and they're kind of like anti-government, slightly conservative, but like a little interesting in their take. Basically, the Fed is going to talk, but everything they say and do is worthless. They're focused on the Fed funds rate, which is an overnight rate that banks lend to each other. And they're saying pretty much everything they're doing right now is they're behind. And now there's some data in what they said, so I'll explain to you, and you can comment below if you think the Fed is any good or doing their job. So the Fed funds rate currently is between 425 and 450. So let's call it 4 and 3. It's 4.375. That is an overnight rate that banks lend to each other. And this article said, well, they're focused on the wrong thing because banks don't lend to each other because they have trillions of dollars in reserves parked at the Fed. So since 2008, they haven't really borrowed in that Fed funds exchange. So we talk about it a lot. Now, they said if you want to watch the market and watch short-term rates, that's where you see what's going on. And they basically said the Fed is following the market, not leading the market. And it was a very interesting take. So if you look at like 1-month treasuries or the SOFR, SOFR, which is a secured overnight financing rate, it's basically like what all of our ARMs are based on and a lot of credit card loans, car loans. But those are short-term borrowing rates, and they are low right now, and they're lower than the Fed's funds rate. And so, you know how I always like to watch the 2-year treasury, but this article said follow the SOFR on the 1-month treasury. And they said the Fed is behind, and they've been falling behind. And they talked about the dual mandate and how it's possible to have maximum unemployment and price stability, which means low inflation. Remember, it's really a tri-mandate because they're also responsible for long-term interest rates. So a year ago in January, actually, I apologize, January 23, I think we're at 3.4% unemployment. We're now up at 4.2. So it's been coming up since January of 23. So for 2 years, unemployment's getting worse. And they're saying the Fed's behind on that. And the market having lessening yield on short-term rates is an indictment that the economy is slowing as it relates to employment. Inflation, we've been pretty low as well. I think 2.4 on the CPI, and we've made our way all the way up to, was it like 2.8 on the last one? So look at the CPI. So So anyway, they're saying the Fed's behind, and basically the Fed's worthless, and everything they do is worthless, and the Fed funds rate is worthless, and you just got to watch the market, and they're following the market, not leading the market. So the dollar has gotten a little bit weaker. Obviously, if yields come down, dollar gets weak. That's good for foreign investment, not necessarily good for us. And this whole article basically just damned the Fed. So I know there's some Fed haters on here. Let's get you riled up and into your head, and just throw emotional intelligence out the window. I talk about it a lot. Just throw it out the window. Let's get nasty down there in the comments about the Fed. So this meeting is going to be a hawkish pause. They're not going to do anything because they don't have to, and the market will continue to trend down in yields and mortgage interest rates and SOFR and 1 month security. So that's the hot take. Okay, the job openings ticked down a little bit, but still there's like 1.9 million continuing claims and something like 7 million job openings or some weird number. But jobs are a great spot. No big deal there. GDP is shrinking, and we'll see what it comes out to. The tariff problem is interesting because we're going back and forth, but April 2nd is a really big day and when they go permanent. And when I heard a gentleman on CNBC, a little clip I listened to today, he basically said that there's supposed to be over $1 trillion of income taken in to the United States revenue over the next 10 years for these tariffs. Sounds pretty permanent. If they're trying to use that in the CBO scoring, which is what's used to decide how budgets are passed. Tax cuts don't get credit in the CBO. The CBO uses a run rate of like 1.75 on GDP. We haven't been that low in a while. So we got a continuing resolution passed. That was a big deal. Government is a big driver of inflation. And so, just watching the tariff talk and the volatility bring the market down to where it has been, I know it's unnerving. Again, on my last video, I was telling you, talked to a lot of people at ICE. They're talking about their stocks, accounts. Like the NASDAQ 100 ETF had 16 trading days in a row where it was, at least intraday, down 1% for 16 days. I mean, that's the fifth fastest shrinking of the stock market over tariffs. So we know fundamentally tech companies for the NASDAQ 100 didn't get decimated because, we're fighting Canada on aluminum and electricity and China on cars and Europe on frickin' wine and cheese and Burgundy, cognac or whatever it is. So we're going to watch the stock market. I know people feel better when their 401ks are up. People are feeling a little unnerved right now. But let me just tell you, I'm not a financial advisor. I'm not responsible for your losses, only your profits. These things snap back. The 10% correction in the S&P 500 is a very normal digestion period after 2 years of 20% plus gains on paper, unless you sold. And so the put-call ratio, puts are betting options for the market to go down. Call is up. So a put down and a call up. The put ratio is finally getting above the call ratio. And this Friday is the third Friday of the month. It's a big options expiration day. And so there's a lot of pressure and liquidity in the stock markets. So if we haven't already seen a bottom in the stock market, this Friday could be a really telltale sign of whether that's the new bottom or we're still trending lower, or we are already on the rebound. Some stocks are, but again, I can't predict the future. But remember, the third Friday of every month is very pivotal when it comes to liquidity. I mean, there are so many options that expire by the end of the day, within 5 days, and that's a lot of liquidity going around. So what happens is these clearinghouses like Citadel and other market makers, as they're called, they have to buy or sell stock to offset the options that expire in the money, whether a put or a call. So you can play that back over and over and try and figure that out. I've been trading since college, so it's just a liquidity event that's coming Friday. It's a big deal. After the Fed meeting, then we have a PCE reading next week, which is a big deal. Retail sales, we're a little bit of a miss today, which our economy is 70% consumer spending. So retail sales being, headline number just slightly down. Is that another data sign that we're having slowing growth? I know people are talking about recession talk because, there are risk managers out there, Goldman Sachs, JP Morgan, Morgan Stanley. They're risk managers, so they don't want to get caught off sides if these data points do ultimately lead to a recession. If it's just a growth scare And fundamentally, when earnings start to come out, which they will in April, starting with the banks and all their outlook and all their data after April 2nd, after the tariff implementation date on a lot of these major tariffs, we'll start to get some more clarity going into that week, which is jobs week. So lots going on. Hopefully I summed it up for you. Off to Soy Cowboy, which is a restaurant I ate at last night with the good folks at Rice Park Capital. And Capacity has a nice dinner there tonight. ADM, some other people. Soy as in I am cowboy or I am cow boy. Pretty good restaurant. Pretty nice place. Have a wonderful week. I'll get back to you Thursday from Austin with the Strathmore and Mortgage Banker Association Peer Group Review, PGR. We pay money to give them data to go sit in a think tank and talk and strategize. I will say this industry is bullish. We are pretty excited about where we're going this year. And that's a universal truth. It's going to be better than last year. So winter is ending. Get those last couple ski runs in. Get ready to get a tan. Spring has sprung. The clocks are forward. Rates are coming down, generally. Have a good one. Cheers. Hey, it's KP coming to you live from Austin, Texas. But there's Christy and Air. Christy, my co-host on The Last Word, Crispin Commentary. Her husband, Air. Chris is at University of Federal Credit Union. Okay, I am not allowed to talk about this group right here. We're not allowed to talk about this group, but the reason I'm here in Austin, I am under strict NDA. So Strathmore Group and the Mortgage Banker Association together does the peer group review. So it's called PGR. And a lot of lenders, like we submit data, it gets like put in a really well thought out book. And we come in here, it's like a think tank all day today, and then we have a half day tomorrow. So it's my first time to do it, and it was awesome. I mean, it's just very well organized. Mike Frantantoni's here as well, Marina Walsh, and then, of course, the whole Strathmore team. If you're not in it, I think you should check it out. It's pretty cool. By the way, we're on 6th Street. Legendary 6th Street. All right. So existing home sales were good. I mean, still down like 1% from a year ago, but still a pretty good clip. They're like 4.3 million pace, something like that. Jobless claims weekly today were, as expected, I think around 233,000. And, but the Fed spoke yesterday. So let's talk about the Fed. Okay. So if you're still with me with all this scenery after all this walking around, it is absolutely gorgeous, by the way. I mean, here in Austin, like it is great. So Fed, big day yesterday. You remember my video on Monday from TMC said the Fed don't know ish. Like that's instead of saying the S word, that's what you say. So in that same article, it was very interesting. I wrote it down then, but I didn't say it the other day because the dot plot is what came out and was very important yesterday, or so you may think. And so this article said the dots are absolutely worthless. Nobody that's an insider actually believes anything they say. The Fed doesn't know how to predict the future. And that was an article I'd read over the weekend leading up to the Fed meeting. And everyone, oh, by the way, it said it's a media talking point. So I don't consider myself media, but I'm certainly going to talk about it. By the way, I'm in true fashion and trying not to get hit by a car coming down the hill. So the dots are an interesting talking point because, you know, every other Fed meeting, the Summary of Economic Projections, aka the dot plot, the Fed kind of says, hey, here's what we're thinking about, you know, GDP, unemployment, inflation, all these different things. My God, these birds are literally crapping on my head. I hear it's good luck. So it was an interesting take, a hot take about the dot plot, how they're meaningless. But I do want to just address that what they show is trends. So they have GDP this year going from 2.1% at the end of the year to 1.7%. So 1.7%, remember like in the past, like 2 quarters in a row under 2% GDP was a recession. Now there's like this whole thing with this economics board, and they got to check out all this stuff, and they got to look back a year later and then tell you, we may be in a recession now. I don't know. And the unemployment rate they have going up to 4.5%, and inflation they had at the end of the year 2.5 up to 2.8%. So it's not that they may or may not be accurate. It's that this is the trend that they're thinking right now in the moment. And so then I watched the presser on my flight on the way out here yesterday, and there was a ton of uncertainty, tariffs, uncertainty. And so it was in all the questions. Jerome Powell was saying it. And obviously, he got to get back at Trump, who's been bagging on him for years. And so he finally had, Trump gave it to him. He's like, there is uncertainty because of tariffs. But what was interesting is the way they explained it was that tariffs have short-term to medium-term effects of uncertainty. And then Jerome Powell said the long-term effects is slower growth and higher inflation. So they also said they don't know anything. They cannot predict the future. They have no idea what's coming. And all of their projections, they're like, we don't know. There's too much uncertainty right now. So, there's a credibility issue there. But they did use the word transitory again, which, remember, they were using transitory inflation from the pandemic, which, if you look out 3 years, did finally transition away. But we got murdered up to over 9% CPI inflation in that time. They said tariffs inflation would be transitory as well. So, do you believe it then? Now? I don't know. Now, the biggest thing that came out of the Fed's meeting, absolutely the biggest thing that came out, was that they reduced quantitative tightening. So if you guys will recall, so this is where I'm going to just get into and if you've been with me this far in this video, just listen up, because this is probably the most important thing. We buy and sell money. Liquidity makes the world go round. Credit makes the world go round. Money makes the world go round. The Fed has been shrinking their balance sheet. So they've been drawing liquidity out of the global economy for years. They've shrank their balance sheet by over $2 trillion. That's a big deal. And the mechanism and the way they did that was they have a very high Fed funds rate, okay? And that Fed funds rate is a borrowing rate, which I mentioned on my video on Monday. It's expensive to borrow at a higher rate. So less people get car loans, less people get credit card loans. Housing has been a recession, less people get mortgages. And then they were running off their balance sheet. They owned a bunch of treasuries and mortgage-backed securities they bought during COVID when they were quantitative easy. So this tightening has been running off. $25 billion a month of treasuries have been running off the balance sheet, which means they just let them expire, right? And so they're not technically selling them into the market. They just let them run off. So when their balance sheet shrinks, there's less liquidity and less reserves at the Fed. Now, the point of that is they have to keep reserves and liquidity kind of on par with a growing economy, so there's enough liquidity to keep things going, So the economies have been growing. But what's interesting is by them reducing their quantitative tightening, they went $25 billion a month down to $5 billion a month, which means it's $20 billion a month not running off. And if, let's say, a treasury comes due or expires, they in essence would have to buy it back to leave it on their balance sheet, so to speak. That's probably the best way I can explain it. If anyone can do better, please do below. But basically, it's like a $40 billion swing, because they are going to keep their balance sheet from shrinking by reducing quantitative tightening. And that is not easy, but it's less tightening. And so what they're admitting is that they are getting to a point where they don't have enough treasuries and there's not enough liquidity. Remember, the dollar is the reserve currency of the world. Treasuries are a form of a dollar. And, 53 or 54% of all the world's, economic transactions are done on the US dollar. And so if everyone needs more dollars and things are tightening up, then this will help in a way be less tight. Now, Fed cuts. They projected 2 cuts by the end of the year, same as last time. They didn't really change that. But what's interesting about that is one of my subscription services has been harping on this for years. The Fed, of course, they're looking at unemployment and they're looking at stability of prices, their dual mandate. But don't forget, he did say long-term interest rates, which is really the tri-mandate. They got to make sure the 30-year long bond doesn't have too high of a yield, because then we can't pay our debt, and it's not good. Anyway, but the market mechanics, the last point I'm going to make about market mechanics and liquidity and all that kind of stuff. So Germany, UK, Korea, China, Japan, there's a lot of countries out there that aren't doing great. And if they go into recession, they have to inject liquidity to help grease the skids and get the flow of money going. And they cut their rates. So all their central banks cut their rates. So if you remember when the Fed started cutting rates, we kind of waited till the other economies started cutting rates and the other central banks. And so if they continue to do that going forward, we're going to have to bring ours down so we can help grease the skids, because that means things are slowing down. We need more liquidity. So there's a lot of mechanics to it. It's not like if unemployment at this or if inflation that, then we go. Liquidity around the world is a big deal, and the Fed drives the bus. That's the bottom line. So hopefully you stuck with me last couple of minutes there. I could talk about a whole bunch of other stuff. It's been 10 minutes. Look out for Christy and I at the last word tomorrow. I'll be doing it as soon as I walk out of the PGR here with Strapmore. And finally back home tomorrow, at the office for a few days. And then I go to Zactus Advisory Board next week up in Deer Valley, which is great. Let's go. Have a great one. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Peranio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.